The New Orleans Conference, the world's greatest investment event.
Please welcome your host, Brien Lundin.
Thank you, sir. Thank you, Robert. First, a quick comment. Yes, Byron King, LSU is playing Alabama Saturday night. Yes, I do have tickets, and no, I will not be using them. I will be here. The sacrifices I make. But hopefully I'll be able to watch the game at somewhere in the hotel. Yes, as Robert mentioned, when I finish, we will have the reception, so if I start to go over, don't hesitate to start throwing paper at me or whatever you need, because we have a wonderful fair set up. We have open bar, great food, and I hope not to run over. So let's go through this really quickly. I will be going into this in more detail in my workshop later tonight. Why are higher gold prices inevitable, and what do you need to do about it? Well, this in a nutshell is why the higher gold prices are inevitable. The gross federal debt, it is too large right now to be managed by any other means other than some significant degree of depreciation of the dollar. That's the only thing that can happen. They can't raise taxes, they can't cut spending, obviously. They can't grow their way out of it. We can't grow our way out of this debt. It's crushing. But let me tell you a few dirty little secrets on the federal deficit and the federal debt. These are things that aren't widely known and they don't tell you. First off, the federal deficit for 2018 is projected to come in at only $793 billion. That's up a good bit under Trump. $793 billion. Yet, somehow, for the fiscal year ended 2018, or fiscal year 2018 ended on September 30th, the federal debt had grown $1.2 trillion over the previous year. Now, how is that possible if the deficit is only $793 billion? That's because there's about $400 to $500 billion of off-budget spending that the Congress and the government and the Treasury has decided to put off-budget. If you and I decided to do off-budget accounting like this in our businesses, we'd go to jail. But they make the laws so they can do it. As a result, the debt is growing much more quickly than most people realize. And the growth in the debt is accelerating. The debt grew $1 trillion in just the last 6 months of fiscal year 2018. Now, if you look out there, there's a lot of analysts that are yelling and talking about doom and gloom, how the federal debt will grow to $30 trillion in the next 10 years. But if you look at the chart I did earlier with the historic trendline growth rate, that's 8.79% since the Federal Reserve was, actually since 1900. The trendline growth rate for the federal debt is 8.79% a year. At that rate, the federal debt will grow to $30 trillion by 2022. That's the end of Trump's 8-year term if he gets that. The point being, the federal debt is already out of control. So what does this mean? Is this unprecedented? No, it's not. This has happened over and over again throughout human history. It happened in ancient Greece. It happened in every instance of recorded history. It happened in ancient Sumeria. You know, back in ancient Greece, there were probably Peter Schiffs and Rick Rules and James Grants walking around in their robes and saying, debt's out of control, spending's out of control. It's always happened when, due to wars or entitlements, governments overspend. And when they do, they make that debt cheaper. They make it essentially go away by depreciating the currency or defaulting on the debt. That's why Cicero said to be ignorant of what occurred before you were born is to remain always a child. But Cicero was speaking on deaf ears, because this is what happened about 100 years after Cicero was alive. You had the Roman Republic had gone away. We had emperors in Rome, and emperors had bread and circuses and wars to maintain the empire. They overspent. This is the devaluation of the Roman denarius. Now, if you look at the last part of that, the steepest part, if you look at those red dots are emperors that left office feet first, essentially. They were not voted out of office. And that is what happened during that steep drop in the Roman denarius. The steepest drop happened over a period of about 50 to 60 years. Again, this is not unprecedented, but we think it can't happen here. This is what's happened here. This is the purchasing power of the consumer dollar. This is what's happened to the dollar since we took silver out of US coinage in 1965. It's lost about 87% of its value, of its purchasing power. And of course, this is by the government's own measure. This is by their estimation of inflation through the CPI, and we know how trustworthy that is. We know that there's an inherent bias to underreport inflation. So it's actually worse than this. But if you look at it, hundreds of years from now, historians will look back and say, you and I right now are living through the destruction of the dollar. And as we know, it can go lower. So what happened over that same period? We had the purchasing value of the dollar going from the upper left to the lower right, and generally, we had the relative value of gold going from the lower left to the upper right. Now, obviously, it wasn't a straight line. It doesn't work that way. People will tell you, pundits will tell you that gold is a lousy inflation hedge, and they'll bring up oil, they'll bring up something else, or tips, and how that's a much better inflation hedge. The correlation is much better. It doesn't work that way. There are periods. If you can pick your beginning and ending points, you can prove any fact. If you allow me to pick data points of 11 p.m. and 4 a.m., I can prove to you that the sun never rises. What I'm telling you here is that over the general wide sweep of history, when the dollar goes down, gold goes up. Sometimes it's much more quickly, sometimes it's not as quickly. But if you're looking for a way to hedge against the inevitable destruction of the dollar, then you need to be in gold and silver. Now, let's look at it a little more closely. Let's look at what higher rates mean, what this debt means today, this out-of-control debt in an era when interest rates are rising. It's very difficult to get a handle on this. You can get, in the government's budgetary statistics, you can get the interest payment costs in the federal budget. Now, this is not the interest payment costs on the federal debt because, as we know, are actually on the deficit or the debt because there's off-budget spending. So you're not really dealing apples to apples, but we can get a close approximation. Here we see that federal government interest costs are rising much more quickly here as the debt is rising very quickly. Eventually, these interest rate costs, and this again is in a very low interest rate environment. So what's going to happen if we get higher rates? Well, here we see the effective interest rate burden. And I calculated this by simply taking the interest costs annually with the size of the federal debt that year. And you can see the effective rate. We're coming now off a very low period. In fact, an historically low period. Even when interest rates and the federal funds rate was at 0, our effective interest rate cost was about 2 to 2.5%. Right now, it's about 3.5%. Historically, as you can see, though, it's been in the range of 6 to 7% as recently as 10 years ago. And of course, if you go back to the 1980s and late 70s, you can get up to ridiculous numbers of 16, 18% interest rate burden on the federal debt. But now we're coming off, again, a bottom in interest rates. Rates are rising. So what happens if we get back to even these levels of 10 years ago? Well, this is what happens. Now, if you take the current debt, which is debt held by the public, which is about $15.7 trillion, and you apply these effective interest costs at these rates, this is what happens. Typically, it bounces all over the place, but in a normal environment, the effective interest rate is about 3 to 4 basis points, actually in the 3 to 4 points above the Fed funds rate. So if the Fed gets to 3 to 3.5% on the Fed funds rate, which they'll probably get to by about mid-year next year at this pace, then that means the effective interest cost burden on the federal debt is going to start rising toward more normal rates, which will be in the 6 to 7%. And as you can see, that means the interest rate, the burden, the interest payments paid on the federal debt will rise to over $1 trillion. Right now, they're a little bit over about $350 billion. So we're talking about in the relatively near future, over a couple of years, if the Fed gets the Fed funds rate up to 3.5%, we're going to be paying over $1 trillion in interest every year. That's more than defense, more than entitlements, more than just about anything else, and a large portion of that is going to be sent directly to China. Now, you tell me what the political probability is of that going over. So the bottom line here is that we are going to have to reduce the cost of that debt through a significant depreciation of the dollar, or have some degree of default on that at some point. The bottom line is we're going to have a market that's very similar to what we had in the early 2000s, when we saw the gold price go up tremendously, when junior mining stocks leveraged those gains and multiplied in value, and you had 4 and 5 baggers, even 10 and 20 baggers in leveraged gold stocks. That's going to happen again. And when it does happen, let's take a look at what that means. This chart, I like to put in all of my presentations, shows real gold, inflation-adjusted gold. If you get to the $850 level of 1980, that corresponds to about $2,758 in today's dollars. So just to equal the 1980 high in gold in current dollars, you're going to be $2,700, $2,800 in the gold price. So just imagine if things get as they were in the late 1870s, a bit out of control, people nervous, interest rates out of control, inflation rising, and the Fed has to come in and clamp down on things. If you have that degree of monetary unease in the markets, then we're going to have gold prices approaching $3,000. So what do you do about it? Let's get into some companies. I'm going to, in a little bit, go rapidly through the companies that are recommended in Gold Newsletter that are exhibiting here, that you can actually go talk to them. But here are about 4 or 5 companies that I'd like to pay particular attention to. GT Gold, as you may remember, I recommended last year. It's a discovery play in the Golden Triangle. It's had a tremendous move. It's come back a little bit since this chart was written. I think it's at a good buying opportunity now. They're finding a porphyry where they had an underground high-grade deposit that was getting too deep. Now they found what appears to be a very large porphyry deposit. Great Bear Resources, I didn't recommend that last year. I recommended it a couple of months after the conference at about 33 cents in our alert service. It's gone up about 10 times since then. This is a high-grade Red Lake type deposit. I would buy this one still on weakness. It's the only junior discovery play out there that has this kind of potential to develop another Red Lake deposit. I highly recommend that. By the way, I do not own GT Gold. I do own Great Bear Resources. Revival Gold is another recommendation of mine I like a lot. In Gold Newsletter, I do not own this stock. I hope to if I can get some money clear. But it is a company that's developing a deposit in Idaho that's about 2 million ounces right now, or looks to be within reach of 2 million ounces. Their goal is to make it 3 million ounces. What's interesting about this play is the management team wants to develop a mid-tier gold company eventually and use this project as a stepping stone. There's a very talented group, and I'm very positive on them. Sojourn Exploration, as you may know, was a company that I was a co-founder of. I've stepped off the board over the past year. They've completely revamped themselves, got in a management team, a new management team, that brought with them about a half dozen properties in the Golden Triangle in BC. You'll see a number of these Golden Triangle properties talking about the red line, which is the key marker geologically in the Golden Triangle for the very large-scale world-class deposits that are being found. The guy that developed that red line, it's actually called the Kaiba red line after Jeff Kaiba. He is the vice president of exploration for this company. I own a lot of Sojourn, so let me be very clear about that. I am very conflicted on this one, but I like the team. You will have time on this because they're not going to be drilling this year. It is a prospect generator. But it is one I would advise you to accumulate on weakness and hold for next year's exploration season. Thunderstruck Resources is another company that I am intimately involved in. I am a co-founder and the chairman. This is not recommended in Gold Newsletter precisely because I am an insider of the company. And as you can imagine, I do own a lot of this one. But I think you should go by the booth. They put out 2 news releases in the last 2 weeks of really significant discoveries on the property in Fiji. And most likely we'll have more news coming. I do recommend that you go by the booth and talk to them, and that's precisely why I have the chart up right here. So I'm going to run through, one more company, Vendetta. This is a special situation. Vendetta has a Pegmont zinc lead deposit in Australia. They're about to complete a PEA, or preliminary economic assessment on the project. Once they do that, it's kind of widely regarded in the industry as the starting point for the company's availability for a takeover. There are about 2 or 3 companies uniquely or well-positioned to make bids for this company. And I would say, I think they're trying to get the PEA done before the end of the year, so that's kind of a near-term opportunity over the next month or so. I like that one as a potential takeover play. As you know, as you can see in Gold Newsletter, we like gold. These are gold companies we like. Atlantic Gold, Aben Resources, Allegiant, these are all companies, again, that are here that you can talk to the management teams. RN Resources, Cabral, Contact, First Mining, Golden Arrow, Golden Predator, Gold Mining, Gold Play, Great Bear, again, Klondike, Lion One, Med Gold. Med Gold's a new recommendation of mine. Integra, New Dimension, Nordic Gold, San Marco, Skeena, Terra X, Torque, and Triumph. They're all here. I advise you, I recommend that you go talk to them. All these companies are recommended for important reasons in Gold Newsletter. Silver recommendations that are exhibiting here: Avino, Exelon, Great Panther Silver, New Pacific Metals Corporation. There's a lot of news on all 4 of these companies. You can get updated at the booths, but all 4 of these companies have made news recently. Base metal recommendations, I like Copper Mountain Mining, Fireweed Zinc, Group 11 Resources, and Trilogy Metals. These are all in the base metal space, of course, and that's really the only common thread between all 4. They all have unique stories to tell. And I think, I won't put any of those 4 ahead of the others. You should talk to all of them. Uranium is recovering, as we know. There used to be about 500 uranium companies in the uranium mania. Now there's about a dozen that are worth looking at. These are the 4 I'm recommending that are here at the conference: Energy Fuels, Fission, GoviEx, and Uranium Energy Corp. And prospect generator recommendations. These are the companies that go out, find early stage projects, prospects, and they farm them out to majors to do the heavy lifting and expensive exploration. Avrupa, Eagle Plains, EMX Royalty, Midland Exploration, Millrock Resources, Riverside Resources, and Sojourn again. These are companies, in particular, the prospect generator sector are companies that you should buy and put away due to the management teams. They like to get other people to to drill, but these are companies that their business model is one that keeps you in the game for the long term, and you're really looking for a good management team for those companies. All of these companies have management teams that I like a lot. Large-scale resources recommendations. I developed this category because when gold begins to move, these companies move first. Typically, and an opportunity is coming up, typically when the Fed raises rates in December, as they're expected to do once again, you have a rebound into late January, February, even going into late spring in the gold price. This rebound since December of 2015 has resulted in these types of companies multiplying 2 or 3 times in value from their December lows. These are all companies you should look at as a buying opportunity in mid-December. Altius, Bluestone, Gold Mining, First Mining Gold, Revival Gold, Sabina Gold and Silver, Sandstorm Gold, SSR Mining, and Triumph Gold. This is how you can find me, NewOrleansConference.com, Twitter, @Brien_Lundin, goldnewsletter.com.